In agriculture, a single shift in weather can obliterate an entire harvest. The financial exposure is massive, and the risk is entirely out of the producer's control. This split-screen matrix shows a classic economic scenario. On the left, a farmer faces a volatile income distribution, swinging between 10, 30, or 50,000 euros. On the right, they buy an insurance policy, locking in a certain 46,000 euros after the premium. According to the von Neumann-Morgenstern utility theorem, a rational, risk-averse agent will always prefer certainty over a gamble. The von Neumann-Morgenstern theorem is a foundational economic model predicting that individuals will consistently make choices that maximize their expected payoff. Under this logic, the farmer should eagerly accept the contract on the right. Yet in 1986, economist John Quiggin looked at global data and asked a simple question: if rainfall insurance is efficient, why does it not exist? The empirical data shows a complete void. Without massive state intervention, direct premium subsidies, or public reinsurance, purely private crop insurance markets are virtually non-existent anywhere in the world. This persistent market gap highlights a conflict between economic theory and the reality of agricultural production. The widespread absence of private coverage points to a deeper issue with how we calculate risk for a biological industry. Before 2003, the European response to this volatility relied on blunt force. The Common Agricultural Policy, or CAP, maintained price stability through guaranteed minimum prices and state intervention buying. The CAP is the European Union's comprehensive framework of agricultural subsidies and programs. By artificially locking prices, governments created an implicit risk buffer for farmers. The resulting distortions led to market inefficiencies and vast overproduction of commodities. Successive regulatory reforms decoupled these subsidies from production volumes. The policy architecture integrated formal risk management tools, specifically subsidized insurance schemes and mutual funds, directly into rural development funding. Access to these new capital pools requires stringent compliance. Farmers must engage in formal risk evaluation and prove they have planned for adverse climatic shocks. State intervention has shifted from deterministic protection, where payouts were guaranteed regardless of behavior, to probabilistic accountability, where support is driven by data verification and active risk mitigation. This equation represents a second-order Taylor series approximation for the risk premium. It shows the additional compensation an insurer demands to take on a farmer's uncertainty. The critical variable here is variance. For private insurance to be mathematically viable, that variance must be built on idiosyncratic risks. Idiosyncratic risks are isolated, independent events, like a single farmer losing a tractor, which an insurer can easily diversify across a large geographic pool of clients. Agricultural exposure behaves differently. It is dominated by systemic weather events. A severe drought or regional frost does not hit one farm, it hits every farm in the territory simultaneously. This equation models systemic yield risk. Beta sub I measures a farm's sensitivity to broad climate factors that cannot be diversified away. When sensitivity is high, risks become highly correlated, and the insurer's portfolio diversification collapses. To compensate for the reality that all their clients will likely file claims at the exact same time, private insurers must raise premiums to a level far exceeding what any rational farmer is mathematically willing to pay. This pricing gap creates adverse selection. At those inflated prices, the only producers willing to buy the policy are those facing the absolute highest probability of total crop failure. Once covered, the system suffers from moral hazard. Insured farmers frequently alter their production practices, taking on even greater operational risks because they know the financial downside is shielded by the policy. To counter this, insurers must send inspectors to individually adjust losses on every single farm, adding massive administrative costs to an already broken premium structure. The presence of highly correlated, fat-tailed climate risk makes affordable private crop insurance mathematically impossible without external capital or state reinsurance. Fat-tailed risk refers to a statistical distribution where extreme, catastrophic events occur far more frequently than predicted by a standard bell curve. Even if the actuarial math could be perfectly calibrated, the underlying model assumes farmers possess complete probability data. In reality, they operate under Knightian uncertainty. Knightian uncertainty is a state where the probabilities of future events are completely unknown and cannot be calculated. In the absence of hard data, farmers rely on horizontal information asymmetries. They observe peer behavior, turning to informal community networks and herding tendencies rather than optimizing based on formal financial modeling. This chart shows two intersecting cumulative distribution function curves for crop yields. Because the payoffs overlap, economists must apply second-order stochastic dominance. This evaluates the variance and downside tail risk to provide a utility-consistent ranking. Humans rarely calculate dominance curves in the field. Prospect theory dictates that decision-makers suffer from loss aversion, consistently overweighting the probability of rare catastrophic events like a 50-year flood and underweighting standard market data. Their risk tolerance is highly elastic due to risk memory erosion. A farmer's willingness to buy insurance spikes immediately after a severe shock and steadily decays with each passing year of normal weather. Models relying on a static, rational utility curve break down in practice. Effective agricultural policy has to account for the dynamic, context-dependent psychology of the producer. To eliminate the high cost of field inspections and bypass the unpredictability of human behavior, the insurance industry pivoted to index-based parametric policies. This 3D risk box maps hazards by frequency, damage intensity, and correlation. Parametric policies trigger payouts automatically when objective regional data crosses a severe systemic threshold. Systems use satellite telemetry across vast grids to determine if a region is algorithmically triggered for relief. Relying on proxies introduces a fatal engineering flaw into the system: basis risk. Basis risk is the discrepancy between the index payout and the actual financial loss. The most visible form is spatial basis risk. A regional index might compensate an unaffected farm, while a devastated neighbor in an untriggered grid receives nothing. There is also temporal basis risk, where the satellite measurement completely misses the critical agronomic window, capturing data only after the crop has already sustained irreversible stress. Actuaries often overfit indices to match historical data. When rapid climate regime shifts introduce novel weather patterns, these highly calibrated models fail in live seasons. The operational result is a persistent pattern of false negatives. The farmer's field is destroyed, but because the strict satellite parameters were not met, the algorithm denies the claim. A single false negative event is enough to permanently sever institutional trust, resulting in widespread abandonment of the insurance program the following year. A theoretically perfect algorithmic index achieves nothing if its statistical blind spots systematically alienate the exact population it was engineered to protect. To solve the basis risk trap, the latest CAP frameworks introduce the income stabilization tool. It abandons weather proxies entirely, triggering a payout only when a farm experiences a 30% drop in its 3-year rolling average income. This introduces immediate measurement risks. Diversified farms can artificially trigger the 30% drop by shifting sales across tax years or holding inventory in silos. This flowchart outlines the modern operational solution, a hybrid risk stack. Tier 1 utilizes a broad area index to release rapid base liquidity. Tier 2 relies on local mutual funds to verify specific microclimate losses and adjust the final compensation. By layering member-owned mutual funds into the system, programs incorporate direct ground truthing. This human verification layer corrects algorithmic false negatives and restores equity to the payout distribution. Operating these local funds require uncompromising governance. To survive correlated shocks, they must rely on hard payout caps, publicly published stress files, and transparent stop-loss reinsurance to prevent capital depletion. The underlying models must remain open source and subject to independent fairness audits. This prevents vendor lock-in and ensures that local cooperatives can replicate and verify the math dictating their survival. Effective risk mitigation requires fusing the scale of macro-level data automation with the precision and legitimacy of micro-level participatory community governments. The ultimate objective of this architecture is linking these localized risk pools directly to global capital markets using instruments like catastrophe bonds. Catastrophe bonds are high-yield debt instruments that transfer the financial liability of a specific natural disaster from the issuer to global investors. Pricing these bonds relies on complex option pricing models, building upon foundational theories pioneered by economists Myron Scholes and Robert Merton in the early 1970s. Integrating ground-level farm data into massive global capital markets shifts the industry toward a model of probabilistic accountability. This transition relies on quantitative engineering rather than deterministic state subsidies.